Chris Frostad, how are we, sir?
Hi, Matt. We are so good today. It's a good day.
It's a good day. And you've been traveling the world. You're in London, was it last week or 2 weeks ago? I didn't get to see you.
Last week. Well, it's the end of the week now, but last week we were at the one-to-one in London. Yeah.
Gotcha. Okay. Well, I was at the one-to-one as well. But I just come back from Australia, and I have to admit I was rather tired.
I guess.
This traveling malarkey,
Well,
this jet set world we lead. It's not a lot of fun, is it?
Well, you're settling into Minds and Money next week, so that'll be close to home.
Yeah. And then I'm disappearing to Sri Lanka for 3 weeks to find myself.
That old chestnut, yeah.
Yeah, I'm going to find myself in Sri Lanka. I just hope I don't find that it's raining, as the current forecast suggests. Right. Okay. We're kind of picking up where we left off about, I think it was about 3 weeks ago now, between your traveling and my traveling. Maybe even been longer. It's around the 26th, 7th of October, I think.
End of October, yeah.
Yeah. So we thought we'd pick up on that. So we were talking then about like financial engineering of exploration, right? Basically, how do explorers actually get financed? And I guess most importantly, get valued. And I think out of the 5 topics, which was, I think, flow through fatigue, the exploration treadmill, private money in uranium, and the exploration venture fund idea, which I think is a good one, and valuation blind spots. We got through a whole one. It's just flown through fatigue.
So that's because you turned on me at one point, and that became more fun. So
we did it in a friendly way, in a familial way. Families talk to each other like that.
Yeah,
families talk to each other like that. It's fine. It's fine. I did get a bit of stick for that. I have to say a little bit of feedback to calm down. So that's why I'm going to Sri Lanka to find myself.
It doesn't kill us.
I'm joking. I'm not going to. I'm going to be as polite and probing as ever. Well, look. Why don't we kind of pick up with the exploration treadmill bit, because it's one of those. There's one of your phrases, not mine. I don't even know what it means. So maybe we should start off with when you talk about the exploration treadmill. What do you mean in practical terms?
Well, we're talking about news flow. Actually, and of course, the challenge we have is investors are looking for a regular cadence and update in news flow, and always, of course, in some sort of positive fashion and advancement. And the problem, again, we're talking about exploration here. The problem is exploration is a little lumpier than that, and you can put out updates every week or every month or what have you, but they tend to not actually provide you with anything more, because we are the nature of what we do is like I say, it's lumpy. We've got you're drilling based on seasonality, on access to where you've got to go. You're doing work today, but you're not seeing the results for a few months. And once you get those results, you want to interpret them and analyze them in a way that makes sense. So it doesn't come out. It doesn't actually come out in a way that that investors want it, need it, are looking for it. So they're looking at, and so from our perspective, what happens is people are demanding news. They're demanding updates. Tell me what's going on. Tell me what's going on. So we have to now start adapting to that, because we can't just ignore it. It's how we survive here.
But think about it. I remember back to when we started this Crux investor thing off the back of, I came out of the world of, banking, and came into this space, junior market space, and go, well, where do we get the information? We had to go and speak to the companies, because the websites were crap. Their communication, there's you'd be lucky if you got a press release each month. And even then it was just it was all pretty weak stuff. I think, during COVID, I think all the companies have kind of upped their games because they've had to. They couldn't travel, they couldn't sit in front of bankers or investors and talk this game. But it's kind of, it feels now it's kind of gone the other way, where investors are now expecting much more regular news update, which they simply didn't get 5 years ago. I certainly didn't see it anyway.
Well, I think the channels have changed as well.
And the channels changed, and that's the point.
The communication channels have multiplied. I mean, back in the days that you're talking about, yeah, we had to get on a plane and we would go sit in front of a room full of bankers and tell them our story, and they'd tell their people, and on and on. Or or we would put out whatever, a news update, but you really weren't getting the full story unless you actually sat down and probed and listened to it and heard it. You weren't going to get it. You weren't going to get it in sound bites. And what's changed is that investors in general are looking for sound bites, or they're getting it from a variety of places that they weren't getting it before, be it YouTube, be it Twitter or X or what have you, or online. A lot of these things, it's the same corporate presentation over and over again, but you don't have the opportunity to actually dig in or to probe or to ask questions. You're just getting what's fed to you.
But there's something deeper afoot here as well, in the sense that these campaigns, which are more frequent with more deliverable mechanisms, are kind of lighter touch, but they are very much geared towards, instead of what I think it would have felt like in the old days was old days 5 years ago, it felt like it was wrapped around the geology. Now it seems to be very much geared towards and designed around capital markets, what capital markets need to hear. And I think a lot of juniors get lost in that, and as a result, they all sound the same. I think it's got harder to actually distinguish what good looks like anymore.
Well, because there's more people investing in this stuff than before, and the geology is not easy to understand necessarily, right? And it changes from commodity to commodity, and a lot of people don't have the patience or the time, rightly so, to really understand the pretty colorful pictures that we're putting up in front of them. So they do back into your traditional banker investor questions. What's your market cap? What are you getting paid? What's your float? What's your this, that, and the other thing? But it's all those financial cues, as opposed to what are you really doing under the covers? What do you do day to day? And how is that going?
Well, I know. For me, I think it's all the poorer for it, because you kind of this desperation to kind of manage the cadence of news flow means that everything's just that little bit weaker and diluted, and we've gone into sound. As you said, I use your phrase, sound bites or cliches, which mean nothing or can be interpreted in 180-degree terms. We used to sort of have to go through the process of interpreting, as I say, some of the more technical data for our subscribers, or read between the lines. And I think companies have just got that a little bit cuter as well. And I do think that news cadence versus, maybe real news, like probability of discovery, it's a shame that we've kind of lost that.
Yeah, again, because we have to explain. We're explaining to a different audience. I think there's a lot more retail investors in general than there was 20 years ago, right? I mean, there's a lot more money going into equities than there was 20 years ago, and so people are trying to understand, just simple at home investors, what it is they're looking for, and a lot of the do-it-yourself investment analysts or investment advisors that come online, again, they're dumbing it down to the point of being problematic, because they're just focusing on those same simple metrics that don't necessarily apply when you lift the hood.
Okay, we're going to sound like two moany old men for this first half, I promise, folks. And by the way, I think our following expects it and probably enjoys it. But this kind of capital markets feedback loop, where it used to be a case of you put out a kind of decent drill headline, the stock would pop a little bit, and then kind of come off a little bit. I think what we're seeing at the moment, and I look up because I'm very, very aware of this, when you look at the companies doing these marketing contracts, I'm seeing 100, 200, 500, $1 million contracts being signed by juniors, which is a significant portion of their available funds spent on marketing just because they can pump the market. That is crazy. And I'm talking about, 3-4 month contracts, not even 12-month contracts for those sorts of monies. I'm like, it's insane. You will see a pop in the stock at which point the company uses that as an opportunity to go and raise capital at cheaper, because their stock's up, it'll be cheaper at capital. And then of course, once that pumping, by pumping, it's, you've got these market makers, and we've talked about this in the past, Chris, where then sort of comes back down to at or below where it started the process, but minus 400 million bucks off the bottom line, but having the ability to have raised 10 million, 15 million bucks along the way. So again, it seems like a massive.
Well, in many cases, we've seen it exceed what they're putting in the ground, and it does. But it's a bit of desperation in that they're putting money against a marketing plan in order to get at the audience that they want to get at, and they don't know how to. And there's no direct channel. I can't get in a plane and go see these people anymore. They don't come to the shows anymore. They don't. These investors are sitting at home in front of a screen. And there's people that know how to get to them better than I do. And yeah, it's going to cost me an arm and a leg, because the people that are going to get me there have figured out that I will, in fact, pay that kind of money for it. So yeah, it's problematic. But again, it's trying to drive that news flow. I was watching it was a group of letter writers who you would know, evaluating a junior, and who had a multi-million-dollar marketing plan out of the gate, and again, more money than they were putting in the ground. And they were almost, those who thought there was value there was in the pump. Well, I'm going to pick up some of that now, and they're going to spend all this money, and I'll get out when the money's dried up. And I'm thinking that's just off-putting.
But what's that do for the whole sector as a whole? Because you can pump crappy assets, crappy stock, and it looks great for whilst you're just pissing this money away. I mean, there's one I saw the other, and I will name names, is and they've done it three times now. Apollo Silver, it's not in the uranium game, but Apollo Silver, they've signed. They did two $1.1 million contracts with a newsletter writer. First one, where they worked after 3 months, it didn't fucking work, and they asked for the remainder of their money back, and the guy said no. Then they 2.5 years later did exactly the same thing with exactly the same result, and then just recently, as this week, 2 days ago, just signed another sort of $350,000 deal with another group to let's say a marketing communications company. For a space of 3 months, and they can rotate that every 350,000 bucks every 3 months. I'm like, what? I know the asset, it ain't all that. I think it's got big problems, and you can market that till, for the next 10 years. It's not going to make the asset any better.
No,
but it will, and that's not good for this sector as a whole.
Yeah, and Janie, our person in charge of our communications. She has a couple of other clients, but I remember this is going back a few years ago. But she took on a new client who had a new CEO, who was essentially a highly qualified person in general. But from a marketing perspective in the capital markets, this was kind of his first foray. And when she got there, she realized he had $10,000 a month contracts with like 10 different groups, because he didn't know what to do. Like, what do I do? I guess if I throw money at it, it will make my world better, and it will get my voice out there. So there's all kinds of ways to throw money at this stuff, but it doesn't necessarily work. B, it's temporary if it does work at all. And at the end of the day, you realize you really have to come back to fundamentals, and try and get a message out that's value based. Not hype based, and that's hard. It's hard when you're on this side of the fence, right? Because at the end of the day, I need, if I don't keep my stock price up in some way, shape, or form, I can't raise the next amount of money. I need to go out and work. And
let's try and get on some useful stuff where people can walk over and go, oh, I'll use that. I'll think like that next time I'm looking at something, trying to interpret or value something. So what we've seen is, I guess, lots of good examples of this, where from a technical standpoint, this kind of treadmill, this desperation to drive this kind of cadence of news into the market, it affects the drill modeling, drill planning, and they end up sort of drilling these tiny little step outs because they're desperate not to have some like duster or a shitty return. And I think that again, that those companies are easy to spot as well.
Yeah,
You've got to
and you'll
right.
see that. You'll see when if somebody's hit some, they're starting to step into something, be it uranium or gold or what have you. If you're an explorationist, you might be okay. Now I got to do a 100-meter step out, or I got to drill a long hole at depth. But the organization is now being driven. No, why don't you just do a 5-meter step out and hit that same rock a few more times, so I can get the news out. And and they do that all the time. And if you're not watching for it, you wouldn't know, because they don't necessarily tell you where they're drilling the hole. They're coming up with results. And that's a shame. That's a shame, because now the business is being driven by news flow, rather than the need for news flow, rather than actual progressing in the most intelligent fashion.
Well, yeah, it's interesting. In terms of the kind of I think again with some subject we've talked about in the past is the kind of kill criteria and walking away. Does this news cycle thing kind of create a situation where companies are perhaps walking away from something or parking enough? I mean, you've done a bit of that in pre-ISO days, where you've got a heck of a lot of targets to get after, but if it's not giving you the response in the market, you're thinking, well, do I keep drilling there? No.
Well, you probably can't afford to, but yeah, that is a challenge. It's a challenge when you've got a flagship project or something, and after a year or two, it's just not turning into anything. Or it might be. It depends on the size of the thing. How much? I don't want to say there's a time frame on how long these things can be perspective, but yeah, at some point, if you see that you are really spinning a wheel here on a project, now what you've got to do is somehow transition to another project, right? I mean, now you've got a shelf life, and that's a problem. So what am I going to do? Well, maybe I got to somehow keep the story going on this thing that I'd really rather be walking away from, while I run around and try and find something else to pick up on the other end of it. And then you really have to wonder, what did people invest in to begin with? Were they investing in you? Were they investing in the company? Were they investing in that project? And in exploration, you should, I think, first and foremost, be investing in the project. And that's not necessarily the way it always happens.
Yeah, sometimes it works out, sometimes it doesn't. There was a company back in, I think, like 2020, I think I interviewed. It's called BlackRock Gold back then, and I think they're now called BlackRock Silver. And they were drilling the shit out of something. Can't remember what the name of the first project was. There was nothing there, but they had nothing else to do. They didn't have another asset, so but they were kind of delaying drill results and being quite cute, whilst they were desperately searching for another project to do, and they found another project, and it was much better project than the one that they were pretending was fine. And they kind of maybe got away with one for a while. I think for a while there. I'm not sure it's kind of all worked out in the end, but it certainly bought them time to find that asset, use that asset, use the last of their drill budget on this new asset, actually hit some quite good stuff, and were able to raise some money off the back of that. And I think they went sort of on a little bit of a run up till the end of 22, and then sort of came back, crushing back down to earth until probably even earlier this year, where I noticed they've sort of peaked up again, but that's more about silver price than asset quality. But that was kind of a good example of delaying relevant information to the market, i.e. this is shit, and actually using that time to find an asset, raise some money, and go on a little run for a couple of years. So it was all sorts of cute games played.
Well, but you're also because you're dealing with a public company, it becomes very difficult. I mean, if you're a private company, then okay, enough's enough. I'm not pouring any more money into this thing. I'm going to move on and go do something else for a living. It's hard to kill a public company, like very hard, and the expectations are different. So and especially in these junior explorers, where over the years you see them, shifting from lithium to gold to uranium to whatever, and from Chile to Quebec to whatever. What's an investor supposed to take away from all of that? How do you find somebody who wants to invest in that? It becomes very difficult. But that's what they keep doing. We keep watching that. I mean, when uranium fell off in 2008, 2010, companies didn't fold their tents and just disappear. They started getting into other, they just started adding different projects. I'm going to get copper, and I'm an energy company. I'm not just a uranium company or a lithium, what have you. And how do you keep your investors when that's not what they bet on, right? I mean, you've changed the bet mid roll of the dice, and it's hard. So it is such, we talk about it as a treadmill, but that's kind of the treadmill that people that are running these companies are faced with. Is they won't let me get off. All I got to do is, what am I going to do? Just quit and run away. It's hard.
Well, I know it's hard, and I've got lots of cliches which should be T-shirts, but they did do them as T-shirts for a while for our members. But it's like, show me the incentive, I'll show you the outcome. Never been truer than in the public markets, right? And there's so many which ways with different people within this public market space are incentivized. And if you think you're aligned with some of these other people, you're not. Everyone's got different return. So the investment criteria, which they invest, return profiles they're looking for, timing, amounts. You look out for yourself, is what I'm saying. So all these kind of conversations around, look, if you're aware of some of the games played, you can maybe make a slightly more informed decision about whether or not you want to get into something. But ultimately, this is all in high risk. And exploration is high risk investing. All you can do is try and de-risk it as much as possible by right management teams or right thematic or right timing, and kind of layer your way into investments. But how it's, I mean, that said, so how do you think, if you were redesigning a system from scratch, what does it look like? How should management be rewarded?
Don't go there again.
I can't see it.
Don't go there again.
You're getting nervous.
Well, no, yeah. Here we go.
I will say nothing. Just tell me what you think, and I'll step away and move on to the next question.
Well, it's not. We've talked about that too much, and I don't think it's a matter of compensation. I don't think it's a matter of how do you structure these things. The problem is that we have this all of these, this myriad of junior companies, public companies. And I think at the end of the day that's probably the wrong structure in general to be trying to do this, because again, it's exploration. We know that most of these things don't work at the end of the day. They all have high hopes. They all have high prospects. And when they do, they win big. But like if you're a venture fund, most of them don't. You're looking for the one or two that's going to pay for the other 7 or 8. And so it becomes difficult for an investor to invest that way. And we've got companies, project generators, if you want to call them that, or what have you, that are saying, okay, well, look, let's spread the risk. Let's get a variety of projects in here. I mean, we've evolved into that sort of model. We've got a number of projects that are being financed and supported by major companies, which is a good thing. We've got but there's a lot of companies that are trying to do this as well and spread that risk, but that doesn't seem to work as well. A lot of the project generators, because they're not focused on a particular project, have trouble delivering the message as well. And so I think this notion of trying to fund exploration by creating a herd of small juniors and small public companies for investors to try and wade through and pick through, that's you can't fix that. You're not going to fix that by making investors smarter. You're not going to fix that by putting better people in charge of each of these companies or compensating them differently. That's not going to work, I don't think. in general. I mean, we're talking from a macro basis here, but you're going to wind up with the same, you know.
Yeah, like I know what you're saying.
It's like you say, look at the objective, or look at and I'll figure out what I'll tell you what the behavior it's going to drive.
Totally, you can read it like a textbook, but it's like okay, most retail can't be bothered doing the work. And if you're offended by that statement, I don't mean you, I mean the other guy. So you're obviously smart enough to know.
Well, it's not a small amount of work either. I'm sorry.
It's not a small amount of work.
You're just trying to invest, and if you're trying to diversify, it becomes even harder because now I got to know even more.
I think you can educate people to be smarter. Will they have all the answers? No, none of us do. But I think you can avoid some of the glaringly obvious, pitfalls, pit holes that are out there, signposted in big flashing red lights. And I think that's always quite good. Will you always get it right? No, it's just not going to happen.
But you're right. I mean, is there more noise than substance? Yes, mineralization or me walking into something creates more value, but not for years and years and years. It's got to be more than that. So does it progress to something else? Now, am I talking about like you have to watch the story? You have to watch what's being put out there. Am I giving you reams and reams of tables with dribble all over it? Am I making up terms? You have to pay attention to that kind of stuff. Am I spending hundreds of thousands of dollars on marketing unnecessarily?
Yeah, and I think I've learned that we do these analyst notes and so forth, and I think for a long time we've got it mostly right, but in scenarios like that where I'm pointing out, I'm not trying to educate people. I'm literally pointing at the things which are really wrong with that company, like glaringly obvious to anyone in the industry, the sector. That company is all kinds of fucked, right? The pushback is insane. Rather than saying thank you for pointing that out, I didn't see it, I'm out of here. It's like, you're psychotic Nazi. How dare you talk to me like that, or talk about my investment like that? So it, for me, it's kind of like it's kind of bittersweet sort of effort, response to this situation. And whereas but the thing I've learned in all of this is companies which I wrote about when gold was at 2,000, which were just horrific. I'm talking like companies like Harmony Gold at 2,000 gold, they were breaking even. Big company, whatever, 3 billion valuation, big company making no money. At $4,000 gold, they're off buying copper projects in the Far East. Life is good. So the fact that they are highly and deeply inefficient, not to mention their health and safety, their is criminal, quite frankly. In these gold prices, it covers a multitude of sins. So life is good, and I've learned that maybe to kind of factor that in with our analysis and say, look, whether it's this tin company or this gold company, at today's prices, it's all kinds of wrong. It's all kinds of inefficient. But if the metal price doubles, life is good. I mean, there's the thing which I've learned. I'll put my hand up. I did not appreciate that in a way that I should have. So let me ask the question another way. Just finish off on this topic. Instead of saying, how should this work? Is if you were advising a sophisticated family office or sovereign fund coming into uranium, what are the sort of metrics or behaviors that you would tell them to track so that they can tell whether the company's on this kind of treadmill that we're talking about here, or they're sort of genuinely optimizing for discovery probability and long-term value?
Well, first of all, I'm not sure, and that's another conversation, whether investing in junior exploration companies, public companies, is really within the investment thesis of a family office, whether that makes sense. It probably isn't. So, the advice there would be to do what you used to do, you said, which is you got to sit down with these people. You have to have access to as a family office, you're going to want access to management. You're going to want access to the people in charge. You're going to want to, be in a position to question everything and get that comfort level, because, we're talking about a speculative, high risk, high reward investment. And you're not in the business of doing that. This shouldn't be just a roll of the dice. So I think that would be, if you're just looking for the red flags for the general populace, which I think is where you started, which makes sense. I mean, it's a lot easier for me to tell you what to avoid than it is for me to say this is the thing to invest in, and this is the thing, because that's you're going to get all kinds of opinions on that side of it. But you're right; it should be easier to spot the problem children. So, I mean, if a family office was going to get into investing in this sector, I think they'd have to go at it differently. Because their outcome, their expectation of an outcome is different. It's different than if a major mining company is investing in this kind of stuff, which is going to be different than if a utility is investing in this kind of stuff. So I would say what you probably want to do is manage it like you would if you were investing in a venture fund, right? Which is different. Again.
Well, I mean, I guess that kind of drags us on to the next topic. We talked about, private money in uranium potentially, or exploration venture fund type idea in the space. Should we? I don't think we've got time to talk about all of what was the other topic? We're going to talk about valuation blind spots, I think. Maybe we can. Do you know what? Why don't we bundle up the kind of private money in uranium and the whole kind of exploration venture fund into the kind of next conversation? That might be.
Well, we can, because I think the right way to invest in exploration theoretically is not through public company vehicles, a myriad of them. You have because there's so much money being wasted and not being put in the ground that is aimed at keeping the machine going, the public machine going, and the like. And that's not what you want. That's not what you want because it's expensive to explore, and you want as much money going towards that and as efficiently as possible. And it's the behavior that comes out of the public markets, the juniors, is not. It's creating the wrong behavior, I think, of these companies.
Well, let's look at that. And then there's groups like the kind of Tees River Uranium Fund. You set up the Tees River Uranium Fund, etc., which we can kind of get into and give examples of how new money's kind of coming in. And even, I think, to a degree, we're seeing kind of sovereign funds enter. You kind of got things like the Critical Minerals Sovereign Fund in Canada, and others. We can talk to those and sort of explain, what their remits are, what their outreach has been so far. Maybe, yeah, let's do that in the next chat, which we will do a little bit sooner than the last of 3 weeks we've had off whilst traveling. Should we try and squeeze something in next week?
Yeah. You're going to make me look at my calendar, but yeah, we can. I'm in Saskatoon next week. Later next week, we could do something.
And what's happening? I caught up with Phil Williams of ISO Energy. He seems to be excited about what you guys are doing, and is talking about a quite a decent chunky.
Well, yeah, that's part of what we're out there in Saskatoon to do is finalize. Yeah. We're now finalizing budgets and things for the coming year. As we've talked about, we have a joint venture with ISO Energy, a 50-50 joint venture. We did our financing a little while ago. We're looking to spend probably $6 million on those collective projects in this coming year. And most of that, or all of that, quite frankly, is focused on one particular project where we did start to come into some pretty exciting high-grade uranium. And that'll be how we kick off January, is going back there now that things are frozen up, and follow that up and see if it's leading us somewhere spectacular. But it's going to be a good year, going to be an exciting year. And they're up there working too on their projects. I mean, they've got that hurricane deposit up there that they're continuously trying to make even more spectacular than it already is.
Okay.
Yeah.
Well, let's get that conversation out of the way next week, and then we can maybe return. Hopefully, there's something interesting to say about the markets. I think it seems to be the same old at the moment.
Well, I will mention the long term jumped up to $86. So that's, we've seen it going up $2 a month for the last few months after sitting dormant for a year and a half. Which again isn't the whole message, but it's a good indicator of good things happening.
Okay.
Yep.
Good. Ended on a high. We're still talking. It's all good. Have a good weekend, whatever you get up to.
You too.
And, I'll see you next week.
Will do. Ciao.
Ciao. Bye.